wait for a minute or so.
Can you hear us?
I can hear you now.
Good.
I've got 4 devices here, and my AirPods Pro keep switching between my devices without my asking. So the next thing I know, I'm on my iPad, my iPhone. So it's too clever for its own good. It just tries to detect who needs it the most. So. Okay, I'm going to get started. First, I hope you got my email this morning. I had to change my office hours from this evening to tomorrow. My son has a poetry slam that he's doing this evening. He's a poet, no. So in a sense, he and I don't relate at that extent. I'm not a poet, but I really want to be to be able to listen to his poetry this afternoon. So I've moved it to tomorrow. So it'll be 7 to 8 tomorrow and 7 to 8 New York time tomorrow and day after for the office hours. Are there any questions before we start? Because I know there's a lot of stuff coming at you this weekend. No, and I just want to make sure that things are lined up. I've been sending you emails, but I know the emails are really long. They're tough to get through. So the sequence of what's left is we have today's class and Monday's class, which should finish off the material for the class. Your final project is due by 5 p.m. on Monday. And please do remember when you send in your final project to carbon copy everybody who's one person in the group obviously is going to send in the project as a PDF file, but make sure you CC everybody in the group. So when I grade it, I can reply all and you will all get the graded project back at the same time. So you're not wondering where the project has gone. And if you can get the numbers that you get for your company into me by Sunday night, that will be good because that's what I need for the Monday class. I will actually hold off until midnight on Sunday to kind of get as many numbers as I can. And those numbers, I know that this seems like nitpicking, but I will assign 5% of your project to making sure the numbers are there. I know it's kind of it's tiny amount, but just to make sure the numbers all get into that final Google shared spreadsheet. So get them in as soon as you feel you're ready. Any questions before we start? Okay. And your final exam is a week after the last class. It's on the 17th. It's for 2 hours. As I said, I'll leave the exam will be open for about 12, 14, even 16 hours that day. So you can find a 2-hour slot that works for you. And the rest, it's done. So the clock is ticking. So let me get started on today's session. I know some of you are in my valuation class, and this is going to be a review of what we did in that class, but most of you are not. And what I'm going to try to do is compress what I do in my valuation class into one session. Now, normally that would be a huge climb, but given that much of the hard work you need for valuation has already been done in this class. In what way? If you can estimate cost of capital, you can estimate cash flows for projects. If you can compute an optimal capital structure, you've already done valuation without even realizing you've done valuation. So the way I'm going to approach today's class is I'm going to start by talking about the 4 big ingredients that go into valuation: cash flows, discount rates, growth to get future cash flows, and a terminal value, and talk about each of those separately. And then if I do have a chance and we have enough time at the end, I'm going to actually go through evaluations of the companies that I've covered so far: Deutsche Bank, Baidu, Tata Motors, Disney, and use it to illustrate how everything we've done in this class is actually part of that valuation. So let's start with cash flows. Now, the first fork you come to the road when it comes to cash flows is you want cash flows to equity or cash flows to the firm. Let me repeat what I already said last session. Cash flows to equity are cash flows left over after everybody else has been paid. Interest, principal, all the payments have been made. And those cash flows to equity can be estimated in one of 3 ways. The laziest way is to take the dividends that a company pays and say, those are my cash flows to equity, because why would a company not pay out what it can afford to? It takes a very belief in companies that managers do the right thing. So you can take the dividends and discount them back. That's a dividend discount model. Now, of course, in the last 30 years, US companies have increasingly shifted away from dividends to buybacks. So the second way to measure cash flows to equity is to take dividends and add buybacks and say, roughly speaking, that is what my cash flow to equity would have been. So I'm going to use that as my cash flow to equity. There again, you're trusting companies in the long term to return what they can in the form of dividends and buybacks. Let's call that augmented dividends. The third is you don't trust managers. You say, look, I don't care what companies actually pay out. I'm going to measure what they could pay out, potential dividends. And that's what a free cash flow to equity is. It's the same free cash flow to equity we used in the dividend analysis section. It's a cash flow left over after interest payments, after debt cash flows, cash in from new debt, cash repaid is free cash flow to equity. They're all equity cash flows. Now, of course, you could try to estimate a cash flow to the entire firm, pre-debt cash flows. And the contrast there is, instead of starting with net income, you start with after-tax operating income. EBIT is, of course, operating income or earnings before interest and taxes. You pay the taxes out of that operating income. And then you subtract out what you're putting back into the company. In what? In land, building, equipment, in long-term assets measured with the difference in capital expenditures and depreciation, and what you're investing in inventory, accounts receivable, short-term assets, which you measure with change in working capital. So the mechanics of computing free cash flows of a firm are not complicated. Let's try this. The first company I'm going to take you through with this process is Deutsche Bank, and I'm going to do it at two different points in time. One was in 2008, before the crisis, and one is in 2013. You're saying, what did the crisis do? I'll talk about this in a minute. In 2008, I trusted Deutsche Bank to pay out what it could afford to. In fact, I trusted banks to do the right thing. Why? Because I assumed that banks were run by sensible people and that the regulatory overlay actually worked, that banks would not be allowed to wander off the reservation and do something crazy, do risky things. So I trusted Deutsche, I used the dividends, and the dividends in 2007 that they paid was 6.5 billion euros. So in the 2008 valuation that you're going to see of Deutsche, I'm going to use a dividend discount model. And whenever, as I said, whenever you use a dividend discount model, you're trusting the management of a company to pay out what they can afford to in dividends. Well, you know what happened in 2008, right? You had a crisis precipitated by banks behaving badly. Now, whatever your reading of the crisis is, here's what I read out of it. I can no longer trust banks to do sensible things. Why? Because the evidence was overwhelming that banks did things they shouldn't be doing, that the regulatory overlay didn't really work. So starting in 2009, I've argued that I can't trust dividends on banks. I've got to look at what they can afford to pay out. I've shifted away from dividends to free cash flows to equity. And with a bank, free cash flows to equity are tricky. Because if you apply the traditional measure of free cash flow to equity with CapEx and depreciation and change in working capital, you very quickly run into a brick wall with a bank. Why? Because what is CapEx for a bank? What is depreciation for a bank? What is working capital? It's almost impossible to define. So if you remember when we did the dividend policy section, I came up with a different way of measuring free cash flows to equity for a bank. I started with net income, just like every other company, but instead of subtracting out net capex and change in working capital, I subtracted out what the bank has to invest in regulatory capital. Remember, without the regulatory capital, you're not going to allow to survive as a bank. So in 2016, when I valued Deutsche Bank, Deutsche was in serious trouble. It was losing money. It had been in trouble for almost a decade. Its regulatory capital had dropped below where it needed to be. So the dividend discount model was not even in the cards. You couldn't even use it. So I estimated free cash flows to equity. And I'll take you through the process in a little more detail, but in my free cash flow to equity, I assumed that two things would happen. One is they would manage to turn the ship around and start to make money. They were actually losing money in 2016. I assumed that they would go back to profitability because after all, Deutsche still has a very large commercial banking operation in Europe that it's not going to go away. So I assumed it would recover, get back some of those returns, not go back to glory days. I think those glory days are done. But that recovery will take their net losses and make them into net profit. So if you look at their net income, their expected net income goes from a loss to a profit over time. So it's a pretty optimistic story from that perspective. But to do this, they also have to bring their regulatory capital up because they're too dangerously low in terms of regulatory capital. So if you look at my investment in regulatory capital, I'm requiring them to reinvest huge amounts in regulatory capital because they've just been hit with a shock. The Justice Department had fined them $15 billion for their role in the 2008 crisis, which reduced the regulatory capital. So if you look at the regulatory capital, they're investing huge amounts to get back to steady state. How much can Deutsche afford to pay in dividends? Well, in the short term, absolutely nothing. In fact, not only can they not pay dividends, they will have to raise equity to stay afloat. So this story is a mixed story. I see them recovering back to profitability, but I also see them having to come up with substantial amounts of regulatory capital. And the way this plays out then, if I'm an equity investor in the company, I'm looking at negative free cash flows equity for the next 4 years. And then eventually they will be able to pay dividends. And I'm estimating what those potential dividends will be. A lot more work than just trusting dividends, right? But you know what? That's what happens when you lose trust in management doing the right thing. And with banks now, I've shifted away from dividend discount models with most banks because it really requires a trust in management that I no longer have. So dividends and free cash flow equity. Now with Tata Motors, I can do free cash flow equity in a much more conventional way. You know how the conventional free cash flow equity is. You start with net income, you subtract out capex, you add back depreciation, subtract change in working capital. And if you have debt coming in, you factor that in. And overall, if you look at their equity reinvestment each year, I'm computing what their free cash flow equity will be. I'm also computing how much they're putting back into the business. And in a little while, you're going to see why this matters, because knowing how much companies are putting back into a business is going to be central in estimating how much they grow. And over this 5-year period, if you look at Tata Motors, for every dollar in net income that they've brought in, they've reinvested 88 cents of that net income back into the company. So I'm looking at the past year. I'm not saying the past is going to be a predictor of the future, but at least I'm learning as much as I can from what Tata Motors has done in the past. So I'm looking at past net income, past net capex, past change in working capital to come up with a measure of free cash flow equity. So with Disney, I did dividends and free cash flows equity. With Tata Motors, I did free cash flow equity. With Deutsche Bank, I did dividends and free cash flow equity. With Tata Motors, I did free cash flow equity. With Disney, I'm going to do free cash flow to the firm. I want you to focus on what I'm going to do differently here, because understanding the difference between free cash flow to the firm and free cash flow equity is central to doing valuation consistently. With free cash flow equity, I started with net income. With free cash flow to the firm, I start with operating income. My measure of operating income had to correct for leases, because remember in 2013, accountants were doing that weird thing with leases of treating it as an operating expense. So I had to correct for it. You guys don't have to, because if you're doing a US company or a European company, IFRS and GAAP already does this for you. So I took the operating income, they had 10,032 million. Their effective tax rate was 31%. Already you can see that unlike when I did cost of debt, where I was stuck using the marginal tax rate, here I'm moving to an effective tax rate. Why? Because I'm looking at the tax you pay on all of your income, not on the last dollar of income. Effective tax rate, 31%. The capex was 5,239 million. That included new projects, new theme parks, new movies, whatever they threw into capex. And the depreciation was 2,192 million. So in fact, the net capex is about $3 billion. And their working capital increased by 103 million. I have all the ingredients I need to compute free cash flow of the firm. So here's what I do. I start with the operating income. I net out the 31% taxes. I'm acting like I paid taxes on operating income, even though I don't. I'm acting like I have no interest expenses. That's why this cash flow is often called an unlevered cash flow. You're acting like you have no debt. My after-tax operating income is 6.92 billion. I subtract out the net capex, 3.6 billion. That's the difference between my capex and my depreciation. And I subtract out change in working capital. I come up with a free cash flow to the firm of $3.2 billion. You're saying, what does that measure? It measures the cash available to pay equity investors, dividends and buybacks, to pay lenders interest and principal payments. So this is the mother load that allows me to pay all the claim holders in the company. And if you look at collectively how much I reinvested during the year, I reinvested about 3.73 billion. During 2013, Disney reinvested about $3.7 billion. As a percentage of its after-tax operating income of 6.92 billion, that gives me a reinvestment rate of 54%. Again, for the moment, you might say, who cares? It's last year. What does it matter how much I reinvested? For the moment, file it away. So I'm learning about both Tata Motors and Disney by looking at their history. They're money-making companies which are reinvesting back in their own businesses. Tata Motors is reinvesting 88% of its equity income. And Disney is reinvesting 54% of its after-tax operating income. That's called a reinvestment rate. And it tells you how much a company is putting back into the business. Now, all of this is based on last year's numbers, last 5 years' numbers. You're saying, but I'm doing a valuation. I care about the future. You're right, but you have to start with what you know. And in this case, I'm starting with the last year's numbers to get a sense of what my company is behaving like. Any questions on cash flow computations? Now let's talk about discount rates. And if you get a sense of deja vu, you should, because what I'm going to say about discount rates is exactly what I said about discount rates at the start of capital budgeting. Capital budgeting, why do we care about discount rates? Because they become the rates we use to discount cash flows to decide the net present value of a project, right? Remember the Disney theme park, the Vale iron ore mine, the Bookscape online project, I need a discount rate. And because I need a discount rate, we estimated it. And when we came up with those discount rates, the underlying principle we used was riskier cash flow should have higher discount rates. And we're going to stay with that same principle. We're just doing a big capital budgeting analysis, right? That's what a valuation is. So let's talk a little bit again about costs of equity and capital and when you might use both. And here, I think that word I use, consistency, comes into play. Remember, there are two ways to get cash flows. You can estimate cash flows to equity or cash flows to the firm. If the cash flows you're discounting are cash flows to equity, your discount rate has to be the cost of equity. If your cash flows you're discounting are cash flows to the firm, your discount rate has to be the cost of capital. So let's review. Deutsche Bank and Tata Motors, I'm planning to do an equity valuation. So you know what I'm going to do? I'm going to estimate a cost of equity for those companies and just stop. But for Disney, I'm trying to value the entire firm. So for Disney, I'm going to try to estimate a cost of capital. So here's what my costs of equity look like for Deutsche Bank in 2008 and 2016. In both cases, I was doing an equity valuation. In 2008, I was using a dividend discount model. In 2016, I was using free cash flow equity or potential dividends, but they're both equity cash flows. My cost of equity for for Deutsche Bank in 2008 was based on a bottom-up beta 1.16. Again, a throwback to a very early session. We talked about how do you get the beta for a company? We don't run a regression and take a regression beta. We looked at the business Deutsche Bank was in, and we built up to a beta. The risk-free rate then in euros was 4%. And the equity risk premium then was 4.5%. Risk-free rate plus beta times risk premium gives me a cost of equity for Deutsche Bank in 2008 of 9.23%. So in 2008, before the crisis, when I did my dividend discount model, that's what's going to show up as my discount rate. Move forward to October of 2016. The risk-free rate in euros had dropped to 0.10%. It was close to zero. And this is something that's been a phenomenon in the euro risk-free rate for much of the last 5 or 6 years. In fact, it's been negative for a period of time. It was 0.1%. But Deutsche had become a much riskier bank in the meantime. It had gone from being this very safe and a bank viewed as conservatively run to a bank that was viewed as very risky. Its cost of equity had jumped to 10.2%. So even though the risk-free rate had dropped, Deutsche's cost of equity had risen because it had become a risky bank. So you can have risk-free rates drop and your cost of equity can go up if you do things as a company that makes you a much riskier company to your equity investors. But in both cases, I'm getting a cost of equity because I'm discounting cash flows to equity. With Tata Motors, I'm discounting free cash flow to equity, so I need a cost of equity. And I'm going to say something that's going to sound weird, but I'll back it up. I'm going to choose to value Tata Motors in Indian rupees. Now, part of you is saying, but they're an Indian company. What choice do you have? You can value a company in any currency you choose to. Most of the time, it makes sense to value a company in the domestic currency because all of its financials are in that currency. It's easier to do it because all the numbers are there. You don't have to do any conversions. But there's times when you might choose to value a company in a different currency because you don't want to deal with the local currency. Now, if I gave you a Venezuelan company, the domestic currency, of course, is the Venezuelan bolivar. I'll promise you that you will go crazy if you try to value a company in Venezuelan bolivar because you're going to get 6 digits in inflation. Your risk-free rate might be 15,000%. You start with 15,000% and build up. You're already going to see that you're very quickly going to lose control. So if you gave me a Venezuelan company to value, even though the financials might be in bolivar, I might choose to value in US dollars. You know that until about 10 years ago, if you went to Brazil, every company that a Brazilian analyst valued, even if it's a purely Brazilian company, they did their valuation in US dollars. When Brazilian companies looked at capital budgeting projects, even though they were domestic projects, they did their analysis in US dollars. You know why? Because they did not want to deal with the stuff that came with doing everything in reais, trying to get a risk-free rate, dealing with the local currency issues. I mean, it doesn't mean the problems go away. You're just pushing them to a different place, right? You're pushing them into the exchange rate issue rather than try to deal with it. But you can choose to value a company in any currency. For most of you, your currency choice is going to be driven by where your company is incorporated, what currency it reports its financials in. And for Tata Motors, I'm going to choose to value Tata Motors in Indian rupees. What does that mean? My cash flows have to be in rupees. My discount rate has to be in rupees. To get a discount rate in rupees, what do I need? I need to start with a risk-free rate in rupees. I told you there was going to be a sense of deja vu. To get a risk-free rate in rupees, I found an Indian government bond rate and I cleaned up for the default risk in the Indian government bond. My risk-free rate in rupees was 6.57%. Why is it so high? Because the rupee in 2013 had much higher inflation than the US dollar, much higher risk-free rate. That high risk-free rate is going to push up my cost of equity. In fact, if I bring my bottom-up beta for Tata Motors, reflecting that's an automobile company of 0.964, and the equity risk premium of 7.19%. You know where that came from, right? It came from where Tata Motors got its revenues. It's exactly the same cost of equity I used earlier when I did capital structure and dividend policy and investment. But now it's playing a new role. It's now going to become the cost of equity that I use to value Tata Motors. My cost of equity in rupee terms is 13.5%. So your risk-free rate is based on your currency choice. Your beta reflects the business or businesses you're in. Your equity risk premium reflects where you do business. Any questions on the cost of equity for Tata Motors? That's exactly the cost of equity we got very early in the class when we came up with a hurdle rate for capital budgeting. For Disney's cost of capital, you're going to see a page. This is actually the 5th time I've shown you the same slide. It's actually the cost of capital built up for Disney from the bottom up. I did my valuation of Disney, or let me state that again, just to be consistent. I chose to value Disney in US dollars. I could have valued in euros, I could have valued in rupees. I chose to value in dollars because my life gets a little easier. My financials are all in dollars. My risk-free rate is therefore a dollar risk-free rate, the 10-year T-bond rate, 2.75%. By now, when I show you this beta 1.0013, it's suspiciously precise. That's actually my bottom-up beta for Disney based on the 5 businesses they're in. You can go back to packet 1, slide whatever, 160 or 165. You'll see the build up to a bottom-up beta. My equity risk premium, 5.76%, reflects the fact that Disney gets 82% of its revenues in the US, 18% outside. It's a weighted average of where they get their revenues. My cost of equity is 8.52%. For the cost of debt, I use their actual rating. So in fact, by the time I get to this stage, I already have this computed, right? Because I've done it multiple times. I used a marginal tax rate for my cost of debt. Remember when I did my cash flows for Disney, I used an effective tax rate. Here I'm using a marginal tax rate. And the reason I can live with what looks like an inconsistency is I'm measuring different things. Interest saves me taxes on my last dollar of income. I'm using the marginal tax rate. I use the effective tax rate on my overall income because that's an average tax rate for all of my income. So the 36.1% marginal tax rate gives me an after-tax cost of debt of 2.4%. The weights are market value weights. Market value of equity, estimated market value of debt. And remember, that debt includes my lease commitments converted debt, which I had to do in 2013 because the accountants hadn't done it. My cost of capital is 7.81%. So again, let me emphasize why I did just cost of equity for Deutsche Bank and Tata Motors and why I'm doing cost of capital for Tata Motors. My plan was already preset. I was going to value just the equity in Deutsche Bank and Tata Motors. So I'm doing cash flows to equity and a cost of equity. But with Disney, since my plan is to value the entire firm, I need a cost of capital. The one thing though, when you do valuation that you often don't think about when you do capital budgeting or investment analysis is when I'm doing capital budgeting, I come up with the cost of capital and I just use it because it's one project. But with the company, the cost of capital becomes what you're using to value this company going forward in time. You're saying, so what? Can companies change over time? Absolutely. If I'm valuing a young company, let's say I'm valuing Palantir, or I'm valuing, I don't know, DoorDash, I would expect the company to change over time. In fact, I'm telling you it will change. Why? Because in I forecast growth and margins, I'm telling you a story about a company getting bigger and more stable. You think, so what? What should happen to a cost of capital for DoorDash as it goes from being this young money-losing company to a mature money-making company? Intuitively, what do you expect to see happen to its cost of capital? Jimmy, you want to try? What will happen to the cost of capital for a young, risky company as you make it a mature, stable company?
So I think would the cost of capital start to decrease as it takes on more debt and its projects become less risky?
Safer.
Safer?
Does it make sense to you guys that as you go through time and a company's characteristics change, the cost of capital should change to stay consistent with your story, right? Your growth is shrinking, your margins are going up, a company's getting bigger. I would expect your company's cost of capital to decrease. The reason I emphasize that is in most discounted cash flow valuations, you know what you're going to see, right? You're going to see a one-time estimation of the cost of capital, like 7.81%. And then the analysts would use that 7.81% forever for the next 10 years and in perpetuity. And I don't get that. How can your cost of capital stay frozen over time when your story about the company is changing in your cash flows and margins? So I'm going to open the door and I'm going to walk right through. And here's the door I'm going to open. When you do a valuation, your cost of capital can and should change over time. In the case of Disney, the change is not much. What am I changing it to? Remember, I computed an optimal debt ratio for Disney of 40%. And I said, right now, I don't think they're going to do much. Over time, I think they will borrow money. I don't think they're going to go all the way to 40% or even 30%. I'm going to assume they're going to use slightly more debt and that their cost of capital, which starts at 7.81%, will change over time to 7.29%. Why is the change so small? Because Disney is already a pretty large, pretty well-established company. In the case of DoorDash, the change is going to be much more dramatic. Starting the game, you're going to see an all equity funded company with perhaps a cost of equity of 9 or 10 or even 11%. But over time, if this company does what I tell you it will do on its growth and margins, I would expect that cost of capital to drop to 6.5 or 7%. That's the median cost of capital. So if you look at the spreadsheet that I've sent you to value a company, I do that automatically. So in a sense, I say, look, tell me what the cost of capital is today. And you can tell me it's 9% or 10%. But over time, I move that cost of capital down to the cost of capital that reflects a mature company. It's an option. You can turn that option off and leave your cost of capital at 10%. But then I think your story is internally at war with itself. What you're telling me about your company and your cash flows doesn't match what you're telling me about your company on the cost of capital. This does create a mechanical problem. How do most of you compute present value of cash flow? If you're working with an Excel spreadsheet, William, how do you compute the present value of cash flows in an Excel spreadsheet? What do you do? What do you use?
To be honest, I don't understand the formulas, so I just type out the formula myself and then sum it up.
That's good that you do, because there's actually an even easier option, right? If you look at the functions in Excel, there's a PV function. Very convenient, right? You tell them the cash flows and give the discount rate, and Excel so helpfully takes the present value of the cash flows. Don't use that function if your discount rate is changing. And here's why. When your discount rate is changing, to compute the present value of a cash flow, let's have a cash flow in year 7 for Disney. I cannot discount that cash flow back at 7.6% for 7 years. I actually have to discount it back at 7.81% for 5 years, 7.71% for, so it's called accumulated cost of capital. I actually have to explicitly take 1 plus the first year's cost of capital times 1 plus the second year's cost of capital. The way this would show up in my spreadsheet is I have this line item that says cumulated cost of capital. It sounds fancy, but I'm computing this number because I expect discount rates to change over time. So leave open that possibility that your cost of capital can change, and take advantage of that fact when you have a changing company, your cost of capital should change to reflect those. So we've talked about cash flows, we talked about discount rates. Now let's talk about the input where you're going to have the most trouble in your valuation. Because up till now, everything you've done should be familiar, right? You get your cash flows by looking at last year's income statement, last year's balance sheet, last year's statement of cash flows. You get your discount rate by doing this dance we've done about risk-free rates, betas, risk premiums, cost of debt. Now I ask you, well, what will your company do in the future? What kind of growth rate do you see? And now do you see why people start to get uncomfortable? Because I'm asking you to play God. And you're saying, I don't know. That's your first reaction. I don't know. Why are you asking me? Because without doing it, you can't value a company. A lot of people do valuation without ever asking this question. Because you know how they get growth rates for the future? They look at growth rates in the past. They just take past growth rates, project it out. On every item, growth in revenue, growth in income. This is purely mechanical valuation. If you do this, please let go. Because if that's all you're doing in a valuation, I really don't need a person, right? Because if all you're doing is taking past data and extrapolating, I can have a computer that basically does this for you. It's automated. The reason we need people in valuation is you're the intermediary. You look at the past data and you might use it, you might not. Remember, if you take Marriott, what's the past year look like? Disaster. Why? Because all the hotels were shut down. But you know why it looks like a disaster. And when you do your projections, you might say, look, I'm ignoring 2020 and I'm going back to 2019. When you do this, part of you is saying, this is such a pain. But remember, be glad that you have to do it, because without this, a computer will replace you essentially in a millisecond. So when we think about growth, we often get uncomfortable. And when we get uncomfortable, we try to outsource. You know what I mean by outsource? I told you many analysts with their value companies look at past growth. But just as many analysts, you know where they get their growth rates? They ask the management of the company. Talk about a bias source. What do you think you will grow at? And guess what? Managers give you glowing numbers. We think we'll grow at 30% a year. If you've turned this input over to management, you've lost control of your valuation. So I'm going to go back to a core idea that's worth remembering. Growth is not free. Growth is not something you or I or management can endow in a company. It has to be earned. Let me explain what I mean by that. For a company to grow over time, it has to put back money into the company. It's got to reinvest, and it has to reinvest well. So when I think about growth in a company, there are two questions I need to answer. How much is this company reinvesting? And how well is this company reinvesting? Think about it. Every company, you sit down to value Coca-Cola. How much is this company reinvesting? How well is it reinvesting? You sit down to value DoorDash. How much is this company reinvesting? How well is it reinvesting? And already you can see that the answers to this question will vary across companies, vary across sectors. So let's start with the first question. How much is this company reinvesting? Well, I'm looking at how much of your earnings are you putting back into the company? Now, remember for Tata Motors, I computed how much the reinvestment was as a percentage of net income. I called it an equity reinvestment rate. It was 88%. If I'm valuing Tata Motors, it's telling me Tata Motors is putting 88% of its net income back in the company. And if I'm projecting growth in net income, that's going to become a key input. Is they're putting 88% back, half the game has been won. They're putting money back. If I'm looking at operating income growth, I look at the reinvestment rate. What percentage of the after-tax operating income is this company putting back into CapEx and working capital? If you remember, that number for Disney was 54%. Essentially, I'm looking at what the company is reinvesting. Now, if you look at Coca-Cola, you know what that reinvestment rate looks like? It's tiny. The company reinvests very little back into the company. That's why it can afford to pay the dividends that it does, because its reinvestment is so low. Why? Because its glory days are done. What are you going to reinvest in? You're living off the fat of the colas that were created 100 years ago. You can afford to reinvest very little. Does that mean that Coca-Cola's growth rate is going to be lower than Tata Motors' growth rate? Not quite yet. Because the second question you got to ask is, what kind of returns am I making on this reinvestment? And here again, I'm going to use a familiar measure, at least if you've been keeping up with the project. When you're looking at equity, the measure of how well you invest is your return on equity. So if I'm looking at equity growth, I take what you reinvest, whether it's in the form of, if it's dividends, the retention ratio, but more broadly, the equity reinvestment rate, and how well you reinvest with the return on equity. So as an example, if you have a company that reinvests 90% of its net income back into the business and has a 10% return on equity, 90% times 10% gives me 9%. My growth rate is going to be 9%. Retention ratio or equity reinvestment rate times return on equity gives me growth in net income. If I'm looking at growth in operating income, I'm going to look at the reinvestment rate, but then I'm going to multiply the reinvestment rate to be consistent, not by the return on equity, but by the return on invested capital. It's the same return on invested capital I made you compute for your company. It's now doing double duty to try to explain how quickly can my company grow. So let's try this on Deutsche, Tata Motors, and Disney, and let's see what we get as growth rates. In 2008, I used the dividend discount model to value Deutsche. It was paying out about 67%. I'm sorry, it was retaining about 67. It was paying out about 33%, it was retaining about 67% of its net income. So in 2008, at least looking at the bank, you see it was putting back 2/3 of its net income back into the business. You see, what was it doing with the net income? Reinvesting somewhere. I had no idea where. But the return on equity it was making was 19.45%. So in 2008, if you asked me what I thought about Deutsche, I said, this is a pretty good bank. Not only is it reinvesting a lot of money back, 67%, but it's making a really good return on equity. Of course, what I was blinded by was the fact that banks were doing stupid things. They were pumping up the return on equity by doing risky investments. And that's where my trust and regulatory authorities would have led me astray, because if you multiply the 19.45% by the 67%, the expected growth I would have given Deutsche, if I just used the 2008 numbers, would have been about 13%. So it's just a retention ratio times the return equity. But even looking at Deutsche's own history, you could see that 2007 was a peak year. The return equity was much better in 2007 than it had been over the previous 5 years. So if I looked at an average number over the 5 years, which might be a sensible thing to do if you have numbers going up and down, the return on equity was lower, 11.8% of 19.5%. The retention ratio was also much lower. What I'm trying to open the door to is often when we value companies, we just look at the most recent year. For you, that's already going to be a disaster for many of your companies. Why? Because your most recent year is 2020. And you're saying, what the heck happened? We know exactly what happened. So for many of your companies, when you want to use this approach, you might have to go back to 2019 and 2018 and 2017 to get a sense of what is my company reinvesting and how well is it reinvesting. In fact, using those average or normalized numbers, the growth rate I get is 5.4%. I actually used 5.4% in my 2008 valuation because I did not think that they could sustain what they were doing in 2007. For Deutsche, I'm estimating the growth rate by looking at the retention ratio and the return on equity. I'm saying you got to earn it, and I'm going to see what you're doing. With Tata Motors, if you remember, my equity reinvestment rate was 88%. So instead of looking at the retention ratio, which is what I'd use in a dividend discount model here, because I'm looking at free cash flow equity, and I've got the CapEx and working capital, so why should I trust managers? Let me look at what they're reinvesting. They were reinvesting 88%. They were earning a return on equity of almost 43%. It's mind-bogglingly high. You multiply those two numbers, the growth rate you get is 38%. I don't for a moment believe that Tata Motors can maintain a growth rate. But I've left these numbers in here just to illustrate that sometimes looking at last year's retention ratio and return on equity can give you numbers that you look and say, there's no way. So what should you do then? Look at industry averages. So in a sense, this is still your choice. You're never locked into your company's history when you value companies. You can look at the history, you can choose to use it, or you can choose to say, no way, this company cannot grow at this rate. It's a mature mass market automobile company. And even if you bring Jaguar Land Rover, there's not this much growth left in the future. So look at past data, but don't be enslaved by it. Don't get locked in and say, it's not my fault. That's what that excuse is off the table. This is finally your judgment to make. So if you look at growth in equity income, a big driver of that growth is return on equity. In fact, many of your companies, I asked you to compute both the ROE and return on invested capital. Cody, you have a question?
Yes, just kind of building off of that point, if you have a company that has a continuous negative book value of equity, you'd have to
can't use it. The ROE becomes not meaningful, right?
Yeah.
That's actually a very good point, is if you have negative book value of equity, your ROE just became not meaningful. Now, part of you is going to say, what the heck do? I can't get an ROE. Look at the industry averages. Right? In a sense, if you're a hotel company, and that's why having the industry averages is a good anchoring point, even if you can compute an ROE. For some of you, the returns on equity, especially if you have a lot of goodwill for your companies. I know a few of you send me returns on equity of 120%, 150% computed for your company. And you look at your company and say, there's no way this company is actually earning 120% ROE, even though the accounting numbers give you that answer. That's a case where you say, look, I'm going to throw out this number and replace with an industry average because I think it's a more meaningful judgment on what will happen in the future. Now, one of the things about ROE, and it's good that Cody brought up this issue of a negative ROE, is your ROE can be skewed by things you do as a company. But there's one specific place where ROE is affected, where you get a high ROE. It's not a mismeasurement, but it reflects the way you run your business. And to explain this, I'm going to actually break down ROE. So when you look at the ROE for a company, algebraically, that ROE can be written as the return on invested capital for your company, plus a leverage effect. because all an ROE does is it brings in the effect of debt. You're saying, what's the leverage effect? Let's say that you make 5%, I'm sorry, 15% in your projects and you pay a 5% interest rate. Every dollar that you borrow, you as the equity investor get to keep the difference, right? There's a leverage effect, and the leverage effect is captured by the difference between what you make on your projects and what you pay out on your debt. What I'm trying to say is you can be a very average company in terms of projects and deliver a really high ROE if you borrow enough money. Debt can pump up your return on equity for your company and make your company look better than it really is, because you pumped up the return on equity for your company. So one of the things that you might want to look at for your company, if you have a really high ROE, is where's that return on equity coming from? And if you have a lot of debt, the answer is embedded in that question, because you can see the debt to equity ratio for the company driving up the ROE. What does that mean? You have to be a little more careful about attaching a high value for equity for the company, because even though it has a high ROE, because they borrowed money, their beta should also be high, their cost of equity should also be high. And the net effect might not be great for you. But if you just look at the ROE, it can be a little misleading. Companies can have high returns on equity because they've broken their projects down. So let's make this a little more specific. Okay? Let's assume you're looking at a company with a 15% return on capital, with an after-tax cost of debt of 5%, and a book debt to equity. And why am I using book debt to equity? Because return equity is a book value measure, right? Net income divided by book equity. Book debt to equity of 100%. Vanish, what's the return on equity for this company going to be? 15% return on capital, but every dollar they borrow, they pay only 5% on.
95.
Well, if you look at, if I took no debt, my return on equity would be equal to the return on capital, 15%, right? But for every dollar that I borrowed, remember, I'm using 100% debt to equity ratio. The debt to equity ratio is 1. I'm making about a 10% spread, 15% minus 5%. My return on equity for this company, if I bring those numbers in, is going to be 25%. The extra 10% comes from the fact that dollar for dollar, every dollar of debt pushes up my return on equity. So I'm going to have a 25% ROE. Now, assume you have another company in the same sector with exactly the same ROE, 25%. But it got there without any debt. Why? Because it took much better projects. If I asked you to value the equity in these two companies, they look equivalent, right? Same ROE. I'm going to argue that the second company is going to be worth more than the first company if you do a full-fledged equity valuation. Nihar, why is that going to be? Even though they have the same ROE and the same growth in equity income, why is the first company going to be worth less than the second company? What part in my discounted cash flow valuation is going to capture that?
Because in the ROE, the debt part is embedded in the first company, whereas in second company, the whole part is without debt. So they have still leverage that they can get the debt later on and increase their ROE.
So what input in my DCF would reflect the fact that the first company has used debt to get there and the second company did not?
So sorry, I didn't get that question.
No, but so your ROE is going to be the same. In fact, technically your growth in equity income is going to be the same for the, so if you look at the numerator for both companies, they're going to be the same, right? Same growth rate. So if there are going to be differences, they have to show up somewhere else. So where is it going to show up?
It's in the cash flow, or maybe later on when they, because you mentioned that you can change your discount rate. Here, the discount rate is ROE. So for
Can I
future
ask you a
years,
leading question? You have a cash flow to equity here, right? What do I discount cash flows to equity at? What's the discount rate I need to use? Cost of equity. How do I get a cost of equity? Risk-free rate plus beta times equity risk premium, right? Where do I get betas, or how do I get betas?
Oh, so it's beta. Okay, got it. Yeah. Well, the beta will change.
The beta will be higher for the first company because it's a levered beta, right? The first company has a lot of debt. So they're in the same business. The cost of equity I will have for the first company will be much higher than the cost of equity for the second. So even though the cash flows are the same, the growth rate is the same, the first company will have a lower value. That's why when we do betas, we have to be so careful about levering up betas. Because if you don't, you're going to treat these two companies as equivalent. You're going to give them the same cost of equity and the same value when in fact you should not. Now, finally, if you look at growth in Disney, I looked at the reinvestment rate already. They're reinvesting about 54%. Not bad, right? 54%, that's about half your after-tax operating income. If you remember, the return on capital I computed for Disney was 12.6%. Not bad. What's not bad times not bad? Not bad. In fact, my growth rate is about 6.8%. Now, the reason it's good to connect your growth rate to fundamental things is, let's say you were presenting your valuation of Disney to Disney's management, and you tell them they're going to grow at 6.8% a year. You know what the reactions would be? Oh, that's too low a growth rate. We'd like 9%. You'd say, okay, I'll give you a 9% growth rate, but one of two things has to change, right? To get a 9% growth rate, what are the two ways Disney can get there? It can reinvest more, but if you reinvest more, you'll have less cash to pay out as dividends and buybacks. Or you can reinvest better. The onus shifts back to management. This is not just an input. You can say, what are you going to do differently if you want to grow faster? Given how you've been reinvesting and earning money in 2013, 6.8% is your growth rate. It ties growth to fundamentals. It makes growth less of an exogenous input, a number that you just make up to get to wherever you need to be. So if you have an equity cash flow, you need an equity growth rate. You get there with a retention ratio and a return equity. If you have an operating income, a free cash for the firm, you need an operating income growth rate. You get there with a reinvestment rate and a return on capital. Those approaches that I just described, where you multiply the reinvestment rate times the return on capital or the retention ratio times return equity, work if you have a company that is settled down. Let me explain what I mean by settled down. Its margins have hit a state where you say, this is what the future is going to look like, 13% margins. If your margins are changing, your company is still evolving, then you have to do this. You got to start at the top. You got to start with revenues and work down. And take DoorDash, right? You can't value DoorDash using reinvestment rate times return on capital. You know why? It's losing money. Its return on capital is going to be negative. Its reinvestment rate is going to be negative. The whole thing's going to blow up. So how would I value DoorDash? In 3 steps. First, I'm going to project out the revenues. And DoorDash is a good example, right? Because in a sense, everybody kind of understands the DoorDash business. It's an intermediary. It delivers food from restaurants. So what's going to drive its revenue growth? How big that business is, what percentage of restaurant revenues take the form of deliveries, and what market share of that revenue will come to DoorDash. Because remember, they're competing with Uber Eats and with whoever else, and also all the local delivery services. The restaurant might have its own delivery service. So revenue growth is going to be driven by our story of what DoorDash will be as a company. My second stop I'm going to ask you is, tell me what margins your company will make once things settle down. Right now, DoorDash's margins are negative. Why? It's a young company. It's still evolving. So you might say, look, it's an intermediary. The costs are low. I think my margins will be 20%. You can point to other intermediary businesses, delivery businesses, brokerage business. So revenues have to change over time, reflecting your story. Your margins change over time. And there's one final loose end. If you tell me DoorDash's revenues will go up tenfold over the next 10 years, and that's not unreasonable. It could happen. It's a big market. Then I'm going to ask you a question. This is where I think you tie up the loose end. You say, well, what are you going to have to reinvest in to get those revenues? The reinvestment question here is going to be tied to revenues. You want to grow your revenues. Tell me how you're going to do it. Are you going to acquire other delivery businesses? Are you going to invest in more infrastructure? That's going to show up as a reinvestment. And the way I'm going to measure the reinvestment is by looking at how many dollars of revenues I get for every dollar of capital I invest. Ultimately, I'm taking every valuation and boiling it down to 3 levers. And it might seem simplistic, but they're incredibly powerful at capturing almost every story. The first lever is revenue growth. That makes your small revenues into big revenues. The second lever is operating margins. That gives you the profitability part of your business model. And the third lever is the sales to capital ratio, which tells me how efficiently you're delivering growth. So if you have a company that is, let's take somebody, I was looking at a valuation of Sprouts yesterday. You're all familiar with Sprouts, right? Sprouts is this organic grocery store with healthier, more organic versions. It's kind of this era's Whole Foods. Whole Foods did this 10 years ago, but Whole Foods has kind of become a more conventional grocery store. Sprouts. So if I ask you to value Sprouts, your revenue growth will reflect what percentage of this huge market Sprouts will end up controlling. The plus is it's a big market. The minus is there are lots of players. You got Kroger, you got Target, you got Walmart, you got Whole Foods. So you have to tell a story about where you think Sprouts falls in this. So that gives you a revenue growth. Then I'm going to ask you, what kind of margins are you going to make? You know what the grocery business looks like in terms of margins? Dylan, is it a high margin business or a low margin business, you think? When you look at a Kroger or what is a grocery business?
I guess pretty low margin.
It's a very low margin business. A typical grocery store, even a really good grocery store, makes about 3% margins. That's what Kroger, for instance, which is the healthiest of the traditional grocery stores, the biggest, makes about a 3% margin. Now, the question I'm going to ask you is that where Sprouts is going to end up? So Lee, what do you think? Lee, is Sprouts going to end up like another?
I don't know, because it seems like this is more of a niche business. So I don't know if they're going to have the same revenue as Kroger.
So the first is you're saying the revenue, so they're going to be a 5% market share, not a 30% market share, because Sprouts is not a one-stop grocery store. We shop at Sprouts, but you know what? The reason the old days we actually went to the grocery store, you'd have to have a 3-store stop. You'd have to stop at Sprouts, you'd have to stop at Trader Joe's, and then you have to go to Vons or Ralph's to fill in the rest because, these are not, so you get some stuff, but you can't get everything you need. So given that, that's going to give them lower revenues. But if you've looked at Sprouts, do any of you shop at Sprouts? I don't think they're as big on the East Coast. I don't even know they were around, but you go to Sprouts, you pay higher prices for pretty much everything. And you accept it because in return, you get some interesting food, you get organic, quote unquote, or whatever you get. So your story might say, look, I think they'll have 5% margins. And you got to back it up. Or you can look at Whole Foods in its early days when it's very much like Sprouts, or Trader Joe's margins, about 5%. So you got the revenue growth part of the story, the margin story. And then I'm going to ask you, well, how much will they have to reinvest? And what's that going to depend on? Whether Sprouts is going to grow by opening more stores, or whether Sprouts is going to grow by growing their online sales business and selling more through their existing stores. Do you see why that's going to matter? If you have to open new stores to get the growth, that's much more capital intensive. You'll get much less revenue for every dollar of capital you invest. But if you can grow sales by just having online sales take off, it's a much less capital intensive. And that's what I meant about your story driving these numbers. No matter what the company, your job is to try to take your story for the company and actually convert them into numbers. Lee, who are you valuing? Let's build your story on the spur of the moment. Who are you valuing? Or what's the company?
Chipotle.
Chipotle. Great. So first, what do you think the revenue growth part of the story is?
I think it's been pretty good recently. I think also we can see, I would think they would be pretty optimistic about future years. It's kind of hard though right now. I feel like they obviously did really well in the COVID
environment. On the plus side, they have a good path. The history looks good. On the minus side, Chipotle is already the biggest restaurant chain in the country in terms of revenues, I think. I could be wrong,
like
but I think
McDonald's may be bigger.
McDonald's, but they're already a pretty big player.
Yeah.
So when you think about future growth, you have to think about, hey, if you're already a big player, your growth has to come from either taking market share away from other people. And they're not taking market share away from McDonald's. They're taking market share away from local Mexican restaurants you might have gone to. And let's face it, the easy pickings are gone. They've driven out. So growth is going to be a harder grind. It doesn't mean you're going to give them no growth, but you have to think about it. If you give them double-digit growth, you're clearly already telling a much more upbeat story and has to reflect growing into they're not big perhaps in the rest of the world, so maybe they can get there. But will Germans come to Mexican? I'm not sure. So maybe Europe is not the place you want to go, but maybe Asia might be a place you try. But that's going to drive your revenue growth. When you think about their margins, what's been happening to their margins recently? Do you have a sense of if they've been rising? Forget about 2020. That could be a strange year. No.
I don't have a clear sense. I wonder if the margins actually might be shrinking because they have been emphasizing their use of like higher quality ingredients. And so I imagine some of the costs may have gone up.
Yeah. So, and their prices haven't gone up by enough to cover the new costs. So
Yeah.
at least in the near term, margins are shrinking, but maybe this is part of a new launch, which is, hey, there's a big market for organic, healthy food, and there aren't that many fast food places you can go to. So given your choice between McDonald's, Burger King, and Chipotle wins hands down. So maybe this is a way in which they can get market share away. So the margin story might have to reflect that the good and the bad of this new strategy, which is you have higher revenue growth because you're attracting new people, but your margins are going to be perhaps smaller in the future. And then the final part of the story is going to depend on how do you think Chipotle is going to grow? Is it going to grow by continuing to open restaurants, which in this real estate market is a very expensive way to go? Because remember, I'm going to capitalize your leases, I'm going to treat it as debt. Or is it going to find ways to use its existing restaurant base to grow more? By doing what? By doing what happened in 2020. Maybe it can take advantage of the fact that more people are more comfortable ordering food online and perhaps build its online restaurant business much more, which will affect what kind of sales to capital ratio you have. So if I'm looking at a Chipotle, I'm probably going to see maybe high single digit revenue growth. That'll be pretty optimistic. Maybe margin shrinking a little bit, not collapsing, and maybe a sales to capital ratio, which is much higher than their historical numbers. Why? Because they can now try to grow more efficiently. They're not continuing to open stores because they've got a store pretty much within driving distance of most of the people in America. They've got at least the US covered. So that's going to play out as, and with that story, I'm going to get a value. Is that the right value? How do you know what's right? I mean, this is the value that we get with the story. The actual story might vary. But the three levers we're using to capture the story are growth, margins, and sales to capital. So when I did Baidu, the Chinese search engine company, this was the challenge I faced. They're an incredibly profitable company. Their margins are close to 50%. Why? Because they're the only real search engine in China. Part of the reason for this, the Chinese government has restrictions that have kept Google out of the marketplace. And without Google, Baidu has essentially taken over the market. So that I can explain why their margins are so high and why they've been so successful. But things are starting to change, even within China. Competition is starting to open up from the Tencents, the Alibabas trying to come up with their own. Because in a sense, what do you go on a search engine for? Because you want to search for somebody. But let's say you want to search for a retailer. Alibaba gives you the options of searching. So I think over time, those margins are going to shrink. At least in my story, I see competition picking up because you're starting at such a high level. So in my story, here's what happens. I think they will continue to grow because the Chinese online market is huge and growing fast. So this is a China story. China's growing fast. People are getting online more. They're shopping more online. They're interacting more online. Baidu is going to take advantage of it. So the revenue growth reflects it. The margins are going to shrink over time from 49% down to 35%. Why? Because competition is building up. And along the way, I'm going to assume that they will have to reinvest to continue to grow. Why? In infrastructure, in computers, in acquiring other companies. So every dollar that they reinvest, they get $2.64 in revenues. So where do you get that? That's actually the average for technology companies in this space. So basically, I'm using an industry average to get a measure of how much they're going to reinvest. My story for Baidu is played out as revenue growth margin. So by the time I'm done, I give them $154 billion in revenues. up from 29 billion. That's a pretty upbeat story, but with much lower margins and an investment base that kicks up as they go through time. Revenue growth, margin, and those free cash flows are going to build up over time because as their growth levels up, they're reinvesting less. That's where I get the big bump in cash flows, is I'm no longer putting money back in the business as they become a more mature business. Is this an upbeat story? I think so. I told a story based on what I don't see Baidu growing globally. Why? Because their strength in China comes from the fact that they have no competition. I seriously doubt that Germans are going to be going on Baidu.com doing their search. I think that if Baidu fought head to head with Google in any market outside China, they'd get wiped out because they don't have the advantage they have in China. But I think the China advantage will stay intact enough. You know what could destroy my story? If tomorrow the Chinese government allowed Google to enter China. Does that trouble me? No, it's not under my control. If that happens, and I've got to revisit the valuation, the market will revisit the pricing, but the market is not building in that expectation either. All you can do is reflect what you see in the company today. Talked about cash flows, we've talked about growth rates, discount rates. Let's get some closure here. The closure in discounted cash flow valuation comes from that terminal value. And the terminal value you can estimate if you're willing to assume that your cash flows will grow at a constant rate forever. And what does that buy you? It buys you that perpetual growth model. This is the most dangerous place in valuation, where you can take all the work you've done in valuation and ruin it all if you're not careful about what you do here. Because take a look at that equation. What do you have? Cash flows divided by R minus J. If you're not careful and play with the J, and I'm going to use the word play because that's what you're doing when you take the growth rate and go take it from 2% to 2.5% to 3%. Remember what I said? The cost of capital for a mature company in US dollars is today, it's about 6, maybe 7%. Let's say your cost of capital is 7%. R is 7%. You start with the G of 2%. And you say, you know what? What if I tried 3? What if I try 4? First, I'll tell you what's going to happen. As you go from 2 to 3 to 4, holding all its constant, the growth rate increases, your terminal value will also start to increase. And if you don't stop yourself, you know where you're going to end up, right? You're going to end up with what I call Buzz Lightyear valuations. It's to infinity and beyond, because as R goes to G, the denominator is going to implode on you, and numerator is going to become an infinite number. So what I'm going to do is add a few things about terminal value to try to keep you out of getting into trouble. The first is when you sit down and look at your company, you got to make a judgment about when your company will be ready to put into stable growth. Because remember, I said that growth rate is a growth rate you can sustain forever. And there are 3 possibilities. Your company might already be a mature company. If you're valuing Toyota, don't ask me when it will become a mature company. It was a mature company a long time ago. GM, Ford, any status quo auto company, you're a mature company. You're valuing ExxonMobil. You're already in stable growth. There's nothing really you can do here. Your company might have some high growth left. So if you're valuing Levi Strauss, it's a mature company, but it's a company that historically has not done very well in Asia. They haven't paid much attention to the Asian market. So as the CEO of Levi Strauss, you might say, look, you know what? There's growth, at least for the near term, because we can grow in Asia. But once that's done, we become a mature company. So there's some growth, but not that much growth, and for a finite period. So first case, there's no growth, you're already a mature company. Second case, there's some growth, but you're not. So you could argue that Chipotle is probably a little ahead of Levi Strauss. They have a little more growth, but you're getting to the end of this easy growth phase. But if you're looking at a DoorDash, clearly there's growth. This company's entire value comes from future growth. Everything lies in the future. Remember the corporate life cycle structure that we talked about early in this class, where I said, think about where your company is in the life cycle. We used to explain capital structure and dividend policy. Same thing applies in valuation. You tell me where your company's in the life cycle, we can talk about how far away stable growth is. Michael's valuing Coca-Cola. Where is it, do you think? How far is stable growth? It's uncomfortably close, right? In fact, I would guess that you could value Coca-Cola as a mature company today and probably get a value pretty close to what its value is as a company. So as you think about when your company will become mature, here are some of the things you want to think about. First is you want to look at how big is your company. With Chipotle, that already is a strike against you. It's a pretty big company. You can look at the market. Maybe if the market is large enough, you can say there's still growth here. Baidu was the largest company in China, but the reason it's getting growth is the overall market is still growing at a very hefty rate, so they can still get growth. So you look at the size of your company and whether the market is growing. Second, you want to look at history. I know 2020 might not tell you much, but if your company's been growing at 2% a year for the last 10 years, and you give it a 20% growth rate for the next 5 years, I'm going to come and knock on your door and say, tell me what's changed. Why is this growth suddenly picking up? Alternatively, you have a company that grew at 30% a year for the last 10 years and you give it a 3% growth rate. I want to know what's changed. It's entirely plausible that it's changed, but anytime you're giving me a growth that's different from the past, some of your story at least is to explain that shift. And here's the third one. What are the barriers to entry in this business? If you're a company in a growing business, but the doors to entry stay open, your story has to become more pessimistic. My primary concern, if I'm valuing DoorDash, is the same concern I had with Groupon when it went public. Groupon, when it went public, looked like this really high growth company, right? You're saying this is a huge business, and you were right. You know what you'd have missed on the Groupon valuation is there were no barriers to entry. Now, overnight, you got all these other services doing exactly what Groupon did, and its growth rate dropped dramatically over just 4 quarters from huge 40-50% growth rate down to 8, 9, 10% growth. So look at the size of your company, look at its history of growth, look at its barriers to entry. The more you look at the insides of valuation, the more you will start to recognize that this is not about just getting numbers right. It's about how you read those numbers and use them to project out what might happen in the future. So I'll tell you what I chose for my 4 companies. For Disney, I think there is growth. It's not going to be high. That's 6.8% growth. But I think they have enough barriers to entry in the businesses they're in that they can grow at least at a rate faster than the economy. Why? Because a Disney theme park is unique. You're not going to see this business eaten away. So it's a combination of those barriers to entry and the fact that they still have businesses that are growing. And this was in 2013. In 2021, you know what my added reason for giving them growth would be, right? What's a new business that Disney has started that's kind of exploded out of the box? It's Disney Plus, the streaming business. So when if I'm doing a valuation of Disney today, that might allow me to give it a growth period, even though it's a big company. It's the largest entertainment company in the world. For Vale, it's an iron ore mining company. They're the largest iron ore mining company. How the heck are they going to grow at 10, 15, 20%? If there's growth, it's coming from iron ore prices jumping. And since I'm not forecasting on iron ore prices, I'm going to treat them as a mature company already. They're a large company in a stable, even declining business. Why declining business? Because mining is under assault from environmentalists, from climate change, from all kinds of issues. So I basically am going to treat them as a mature company. For Tata Motors, if I valued them in 2008, before they bought Jaguar Land Rover, I might have been inclined to value them as a mature company. But by 2013, they were getting this growth, and it was coming almost entirely from Jaguar Land Rover growing in the rest of the world. So I'm going to give them growth, but I'm going to be restrained. They're in India, they're already a very large mass market company. Jaguar Land Rover is a luxury automaker, but it's still one of the most established luxury automakers. So I'm going to give them 5 years of growth. So Disney, I'm going to allow for growth to last longer because of the barriers to entry. Vale, I'm just going to put them in stable growth. For Tata Motors, I'm going to have 5 years of growth. And Baidu, because they're in this hugely growing market, which is China, and their protection from competition from the Chinese government, I'm going to give them 10 years. 0, 5, or 10. I'm going to give away the game. I've never valued companies with 12-year growth rates, 8-year growth rates, 9-year. You know why? Because I don't have that degree of that capacity to forecast growth. So if I have a mature company, I'm going to go with no growth, zero growth period. Just go to mature companies, 0, 5, or 10. And I almost never value companies with more than a 10-year growth period. Are there companies that have grown for longer than 10 years? Yes. But we can name most of them, right? They're among the most successful companies in the world. So I'm going to stop at 10 because that's the 90th percentile of growth for growth companies. If you grow for longer than 10 years, that's icing on the cake for me as an investor. I'm not going to build it in. So let's take Vale. It's a mature company, and I'm going to value it as a mature company. I'm going to be a little careful when I value companies as mature companies because the numbers have to be consistent with it being a mature company. So here's what I did. Rather than just use last year's numbers, the iron ore prices can go up and down, I normalized all the numbers. Fancy word for, I used an average across time. Do you see why? Because even though it's a mature company, iron ore prices go up, they go down. If iron ore prices go up, I report a lot of profits. If they go down, I lose money. Their average return on, if you look at the return on capital, their average return on capital in the 5 years leading into this valuation was 17.25%. They want a pretty decent return on capital. Their equity risk premium reflect where they get revenues. If you remember, most of their revenue, 37% of their revenues come from China, 7.38%. For the beta, I used a bottom-up beta, reflecting the fact that there are 4 businesses, and that bottom-up beta is 0.844. In fact, if you've seen these numbers before, it's because I used them earlier when we did a cost of equity and a cost of capital. The bottom line was my cost of capital Vale in US dollar terms. And I chose to value Vale in US dollars, even though they're a Brazilian company, because they're a commodity company. Everything is already in dollars. Why go looking for trouble? Is 8.2%. So here's the bottom line. If I use that cost of capital as that perpetual cost of capital, 8.2%, and I give them a 2% growth rate in perpetuity, because they're a mature company. All I'm left to do is estimate what their cash flows will be next year. So if you take the 17,626 million that they had as operating income, if you look at the average operating income over time, tax rate was 21%, 20.9%. And they're going to have to reinvest about 11.6% of their after-tax operating income. The way I get that is you have a 2% growth rate with a 17.25% return on capital. I am making sure they reinvest enough to sustain their growth rate. The value that I get for the operating assets for Vale is 203 billion. So basically, it's after-tax operating income, net of reinvestment, divided by cost of capital minus the growth rate. I'm doing it right now because it is already a mature company. I'm done. That is the value of my operating assets. I add cash, subtract our debt, I get a value for the equity. The value per share that I got for Vale was $32 per share. The stock was trading at $14 per share. The whole point of valuation is action, right? There's no point in delay. I actually bought Vale, one of my horrifically bad mistakes in investing of all time. And if you want to see why, if you can go on my blog, actually 2 years later, I sold Vale for, I think, $5 per share. And that's not a good direction to go, to buy at $13.50 and sell at $5. And the title of my post was No Mas, No Mas. It's basically Spanish. I got heard from a lot of Brazilians saying that's not Portuguese. And I said, I don't care what it is. I just give up. And I talked about what I got wrong in this valuation. So if you're interested in what I got wrong, you're welcome to go examine it. But what I got wrong was the fact that I thought iron ore prices would normalize. And they didn't. And you know why? Because during these 5 years, iron ore prices had been elevated by China spending a huge amount of money in infrastructure and building. And as that slowed down, iron ore prices came down and they stayed down. My valuation went wrong because my normalization story actually had an embedded story of things will revert back to the way they used to be, at least in terms of iron ore prices. Let me do my Disney terminal value inputs and then we'll end for the day. So I said for the next 10 years, I'm going to assume Disney will continue to grow 6.8% a year. I get to year 10, I'm going to make Disney a mature company. And when I make a company a mature company, I've got to follow some rules. I've got to be internally consistent. First is a mature company grows at a rate less than or equal to the growth rate of the economy, right? Now you say, what's the growth rate of the economy? I'll give you a very simple proxy that you can use. use your risk-free rate as the growth rate of the economy. If you notice all your discounted cash flow valuations, when you enter a risk-free rate of 1.6%, I lock you into that as the cap on your growth rate. You can have a growth rate less than that, but not greater. My risk-free rate in 2013 was 2.75%. And the growth rate I'm going to use is going to be 2.5%, less than my risk-free rate. That makes sure that I don't end up with Buzz Lightyear valuation, where growth rate kind of destroys my valuation. Second, I've got to think about what kind of returns on capital Disney will make in steady state once it becomes a mature company. Right now, Disney makes 12.6% return on capital, well above its cost of capital. Why? Because they have substantial barriers to entry, a brand name that is unmatched. Will that go away? Not completely, but it will start to fade. After year 10, I'm going to give them a 10% return on capital, lower than today's return on capital, but I'm still allowing them to earn more than their cost of capital. Mature companies don't make 50% returns on capital. They don't grow at 7% a year. Third, given my growth rate of 2.5% and my return on capital, I estimate what Disney will have to reinvest every year forever. So if I want a 2.5% growth rate with a 10% return on capital, they will have to reinvest 25% every year in perpetuity. And finally, remember what we said about the cost of capital. If you make your company a mature company, its cost of capital should reflect that of a mature company. So I bring the debt ratio up, and our cost of capital drops from 7.81% to 7.29%. You cannot just change the growth rate in year 11 and leave everything else alone. When your growth rate comes down for your company to make it a mature company, all of the rest of the inputs will also have to change. So I'm going to leave you with that because that's basically going to give you the value of the operating assets. And then I mop up. I add the cash, I subtract out the debt, because when you do a discounted cash flow valuation, you take free cash flows of the firm at the cost of capital. What you've got is the value of the operating assets of the company. You haven't valued cash because the income from cash is not part of your free cash flow. You need to subtract out debt because the value of your equity is after debt. So I call these the loose ends in valuation. You think you're done, but there are all these loose ends to tie up. So what you're going to see in my Disney valuation after I've got the value is I'm going to add back the cash. If they're minority holdings in other companies, 3 or 5% of another company, I've got to add those back. I've got to subtract our debt. I get a value for the equity. And if I've given my managers options in my company, options are not free money. They're part of my equity. I'm going to subtract out the value of those options. That's basically the end game. If I'm a shareholder in Disney, is to look at what's left for me after all of these different claim holders have been dealt with. So next class, I'm going to finish with this as the last part of because I said next class, I'm going to cover everything the class does. I'll hold off on these last few slides because they will show up as part of that last packet, because those are the loose ends I need to tie up to come up with the value per share for my company. So I will see you on Monday, and hopefully we'll see your numbers before then. And reminder again, no office hours this evening, but I will have office hours tomorrow evening and Friday evening in case you have questions. Okay, I will see you on Monday.
First question.
Yep.
Regarding the return on capital for the terminal value period, could it be the industry average? Because if you're assuming that the company will get, I guess, going to mature period,
Or if there are no barriers to entry, what should it converge on? What happens to companies that have no barriers to entry?
Return on capital should be close to 0.
No, return on capital should be close to the cost of capital. It shouldn't be close to 0. 0 would mean that you make no money, you make your cost of capital. So there are two numbers you should look at. One is the industry average, the other is the cost of capital.
Okay.
If you think there are no barriers to entry, the return on capital will actually converge on the cost of capital.
Awesome. Thank you.
Okay. Dad?
When I'm computing the ROE and the ROC, those are all book values, correct? For the book value of debt and book value of equity?
Exactly.
Okay, thank you.
The only place in finance where we use book values. Exactly. Okay. Which is one reason you can get strange looking numbers, because anytime accountants do something to book value, the return on capital and return on equity are impacted, right? You take a big restructuring charge, your return on equity will shoot through the roof, even though your projects didn't get any better because I've written down your book value of equity.
Okay, thank you.
Nihar?
Yeah. How do we calculate the value of equity options? Is it just the exercise price and the stock price? Based on that, we
Yeah, just
calculate
like
that?
any other option. Yeah. It's actually built into your DCF. That's why it's already built in. So if you tell me what options you have, I'll put in the option pricing model, come up with the value of the options.
Okay, got it. Thank you.
Okay.